Now, given the conflict between the Act and the treaty, and not necessarily a conflict, but maybe a difference which could be there in the Income Tax Act and the treaty which India has entered into with the treaty partner, the question which comes up is, if I get a query or if I want to analyze what will be the tax implications of a particular transaction, whether they are royalty or not, whether they are FTS or not, if so, whether under the Act, what's the implication? If the implication is that it is taxable, does the treaty give me an exemption? In either of those two cases, what is the tax rate? All these questions keep on hovering here or there. So how do I approach this particular point? So talking about the approach to the taxation in such a case, it's pretty simple. The first thing is you will see what are the provisions of the Income Tax Act 1961 relating to such a payment. So does such a payment amounts to royalty or FTS as per the provision of the Income Tax Act 1961? If it does, then what is the tax rate? So let's say, for example, you see that a particular payment is taxable, right? Or you see that it is not taxable. If it is not taxable, that's the end of the matter. I don't need to go and look at anything else. But if it is taxable, I will see what is the tax rate or the withholding tax rate on such a payment. So let's take two examples here. In one case, let's say the withholding tax rate is 10% and in the other case it is 20%. I know the rate is going to be the same. In Act, normally it would not differ, but for the purpose of our example, we are taking these two rates. In case it is taxable, then step 2, I will see what are the relevant provision in the tax treaty. Within these provision also, the first thing that you need to see is whether the scope of royalty or FTS is narrower. What that means is there may be some payment which are taxable as royalty or FTS under the Act. So under the Act they are taxable, but under the treaty it might just be that this item may not be taxable, right? If the scope is narrower, it is not taxable, again that's the end of the matter. But if the income is taxable both under the Income Tax Act as well as the treaty, the next thing I need to do is I need to see what is the tax rate for this payment under the treaty. I give you an example to say that the rate under the Act could be 10 and 20. Suppose the rate under the treaty is 15%. When I compare 10 to 15, obviously the tax rate of 10 is more beneficial. So I will opt for the provision of the Act and the withholding tax which will be applied will be 10%. But if the rate under the treaty is 15, but under the Act it is 20, I am going to opt for the provision of the treaty and have the tax withholding at 15%. So the provision of the IT Act 1961 or the treaty, whichever are more beneficial, shall apply. Now we saw that if the income is taxable under the Income Tax Act, there is a particular rate which is applicable, right? If the income is taxable under the treaty, again, there could be a particular rate which is applicable. So how do I ascertain these tax rates? That is something which we are going to look at now. So the rates as well as the income computation is important. Why? The first step is computing income. So if an Indian company pays $100 to a US company, what is the income? Because the rate of tax is always applicable on the income, right? And how do you compute that income? There could be two situations. One, you have to compute the income and see the tax rates under the Income Tax Act 1961. Here basically if you see, there are two sections, section 44D and 44DA. They contain special provision for computing income by way of royalties in case of foreign companies or non-residents. What these sections basically provide is that when you are looking at the taxation of royalty, right, there are no deductions which are going to be allowed against this income, right? Which means that this entire 100 will be treated as income for the non-resident. Once that entire 100 is treated as the income, then section 115A provides what will be the tax rate on royalties or FTS which will be applicable in case of foreign companies. Once you've applied these provisions, computed the income, applied the tax rate, so let's say 100 is the income which you have, 10% is the tax rate which is applied, so $10 is the withholding tax in India. The second step which we discussed earlier also was you need to go and see what is the rate under the relevant treaty. And this rate is given generally in Article 12 or Article 13, right? Even after ascertaining this tax rate, there is one more provision that needs to be considered. And that is, does the relevant treaty have what is called an MFN clause? MFN stands for Most Favored Nation clause, right? So let's say, for example, under the treaty, the tax rate is 15% on 100 or $15. If I had to apply step 1 and step 2, under the Act, tax is 10, treaty it is 15, I will opt for the provision of Act, pay $10 in taxes, end of the matter. But where this MFN clause becomes relevant is that this clause generally restricts the power of India to tax income which is paid by an Indian company or an Indian resident to someone else, which is subjected to any further treaty that India might have entered into. So let's say, for example, in 1991, India entered into a treaty with, let's say, UK. And don't go by the facts, these are just illustrative. In this, India said, I am going to apply a withholding tax of 15% on royalty and FTS, but I also assign to you what is called the Most Favored Nation clause. What this clause says is that if after 1991, India enters into a treaty with another country, right? So let's say that country be X, in which they give the provision which are more beneficial than this 15%. So with the treaty, let's say, which India enters into X in 2000, it says the tax rate is going to be 5%. Then the tax withholding rate which is going to be applied will not be 15, it will be as per the 5% clause. This MFN clause is not going to tell you what is the tax rate which is applicable. It only tells you that if after the entering into of a particular treaty, India signs an agreement with someone else where a benefit is given which is more beneficial, that same benefit is also going to be extended to the other treaty partner. Now, where it makes a difference in this case is that if instead of $15, this would have been 5, by application of MFN clause, you would have thought, why not pay 5 only? In that case, my total tax bill will not be $10, but it will be $5. Now, while we've discussed all these things, there is one more point which you need to see when you ascertain the withholding tax rate for the payment of royalty and FTS. Under the Indian laws, section 206AA, and of course we are going to discuss this in detail, provides that in case the non-resident recipient, so let's say the UK person, does not have a PAN number in India, then the tax rate is not going to be the 10 or 15% as is given in the treaty. But it could be either of 3 rates which are given there, which often takes the tax rate of withholding to 20%. So what is going to happen is that if the non-resident does not have a PAN number, instead of applying the withholding rate as per the Act or as per the treaty, you apply a higher withholding rate which could be as high as 20%. While there are cases which have said that this provision should not apply to treaty cases, it's still a matter which is litigative. There are certain suggested changes in the budget for 2016, where they have suggested that the requirement of holding a PAN should be done away for the foreign company. Right? Now, in such a case, you have to be careful of the fact that this tax rate may actually go up if the non-resident does not have a PAN number in India.